Welcome to this week's episode of Liquid Options. My name is Eric, and in this video, we're going to take a look at a technical analysis trading strategy for buying call options on the IWM using the RSI or the Relative Strength Index. And today's video is a glimpse into a four-part series I put together over on my new research website, and I'm using the RSI for various option trading strategies. And today's video is on buying call options, but the other RSI strategies look at butterfly spreads, bull call spreads, and I'm going to be posting a put credit spread strategy later this month. And really, we're using the same RSI setup that you'll see here in a few minutes, but we're going to apply that to all those strategies. And it's pretty cool because the backtests go back 7-8 years. You can really kind of get an idea of what's been working in the market from a technical analysis standpoint for options trading. So be sure to check the description to learn more about the RSI indicator for trading vertical spreads butterflies. I'm going to put a link in the description. And the RSI strategy for trading IWM call options is coming right up. All right, before we dive into the chart and walk through a couple recent examples of this trade, let's talk about the foundation of it first and why it backtested so well the past 7 or 8 years. So the foundation of the strategy is to take advantage of short-term sell-offs in a bullish market with, the idea that generally when the market's bullish, short-term sell-offs are temporary and that you're going to get some kind of bounce or the trend will continue, if you will. So there's really two things here. Defining what a short-term sell-off is, and also defining what a bull, what we want to consider a bull market to be. So this is where the RSI comes in. And I'm going to go into the studies here, and let's just look at the settings first. And under the RSI, usually the default for many platforms is 14. We're going to use a length of 4. And the overbought and oversold conditions are going to be 55 for overbought, which I know it doesn't seem that high, but you'll understand that in just a second. And oversold is going to be 25. So first off, I want to say that these settings were back-tested by Larry Connors in his new book. I'm going to put a link in the description for his book. It's coming out this month in August of 2018. He used similar settings. Sometimes he used oversold of 30, but oversold of 25 really means there's some kind of significant sell-off like in the market. And as we know as option traders, when you get that sell-off, it's a good time to sell spreads or look for volatility. So in this case, we're just going to look at buying call options during the sell-off or the oversold condition. But again, I have those other studies that I'll tell you about in a minute. So anyway, the RSI settings are period of 4, so it's a very short-term period with an oversold condition of 25 and an overbought of 55. And you can see I have those settings down here already. And the moving average, we're basically going to use a simple 100-day moving average. So if the market, in this case IWM, is trading above the 100-day moving average, that's this kind of maroon line here, and we get the oversold condition, that's going to be a trade entry, and we'll look at the exit. And we're going to talk a little bit about which options to buy, the strike, the days to expiration, and all that stuff. Now, real quick, if you want access to the full backtest, which goes back 7-8 years for this particular trade, it's got the rules, the setting, the methodology, everything you can kind of refer back to. I definitely want to invite you to join my new option research website. You're going to find a link in the description. The membership includes all the other RSI strategies as well. So if you're not really into buying call options, you really want to stick to spreads. We got bull call spreads, butterflies, and I'll be posting the put credit spread study later this month, actually. So definitely check that out, and I'd love to have you over at the research website. So let's go ahead and walk through the most recent examples of this, and you can see it's pretty easy to follow. On this particular day, this was June 25th, 2018. You can see that the RSI, first on the chart, you see that we have a nice 3-day sell-off. And this caused the RSI to really get oversold below that 25 level. But the market was still trading above the 100-day moving average. So this is a day that we would initiate buying a call option. And we'll look at the strikes and stuff here in a minute. And then you can see that 2 days later, it triggered again. The RSI kind of moved up and moved back oversold, and we're still trading above the moving average here. So this actually would be 2 trades. In the study we did, we we allowed 3 open trades at a time. So that's what the full study goes, because you're kind of legging in, if you will, with the idea that you're going to get some kind of reversal. So on this day, 625, we bought a call option, Delta 70 we're going to look at, and we bought a call option here on 627 2 days later. Again, same Delta, but it's going to be a different strike, as you'll see in a minute. And then on this day is when the RSI moved back above 55, and this is the day that we would close the option. So it's very short term. Typically, these trades were anywhere from 2 to 5, maybe 6 days. And the profit really is dependent on how fast the reversal is. So obviously, if we bought this call option, and you'll see this in a minute, and this call option, and this call option on this day, this call option is closer to the bottom, therefore you'll get more profit here. But the legging in really allowed you to not go all in on one trade, and you can kind of really get to the bottom where that sell-off is going to be. So let's go ahead and look at we're going to go to the Analyze tab. And again, we're going to go and analyze that particular trade. We're going to go back to June 25th. And basically what we're going to be looking at is buying a Delta 70 option that has 20, give or take 20 to 50 days to expiration. So I typically like the first month out, but I like to have 20 days. Sometimes, you can go 18 days or something like that. But so let's go 20 days. So in this case, this is the Delta 70 option. So it's in the money. And we're going to do a simulated trade here. So you can see, so on this day, this option would have triggered about $5.50 for that option. And then 2 days later, we said it triggered again. And so we would, the same expiration here, but this time the Delta 70s changed a little bit. So if we went with, 69.71, so we go with the 159 here. So now we're in 2 trades. One was initiated on 625, 627. They're different prices because the pricing changed with the price and all that. And they're same expiration, but different strike prices. So this makes sense too, right? So 2 days later, that first trade, you're actually down in the trade because it moved against you and you initiated a new trade. So if we go back to the chart, we initiated the trade here, and oops, down arrow, here and here. And then on this day, we're going to exit the trade. So this particular day was July 5th. So let's go back to Analyze tab. And this is the P&L date. So we're going to change this just real quickly to July 5th. And you can see that that's the day we would exit. So we got a little bit of a profit on the first entry. In this case, we'll call it, just under 20%, 15, 20%. Again, this doesn't include commissions. And the second trade, we got in for 561. And the option would have closed out for about a $269 profit. So again, that's closer to maybe 40, 50% gain. And that's it. You're out of the trade. So it's a pure technical analysis setup. Now you do have to choose the right options here. You want to go with in the money options. The backtest is going to do Delta 70 options with about 20 to 50 days of expiration. And again, you can do up to 3 trades and you exit when the RSI gets overbought, and that's it. You're not trying to catch some kind of longer trend or anything. You're really just looking for that high probability short-term reversal with a higher probability in the money option, in this case, Delta 70. So if you'd like to see the results, again, of the full study, definitely check out the Research Center. In the description here, I'll put a link. You'll also get access to the butterfly strategy and the bull call spread. And again, I'm posting the put credit spread later this month. And it's essentially relatively the same strategy, but it's pretty cool to compare which strategies kind of performed differently. And again, we're using the same RSI, a 4 period. And we're, a couple of the other settings are different. We're going to do one on SPY. We did one on SPX. So we're kind of changing it around. I definitely, are focused on the indexes with this particular strategy. But again, check that out. I hope you enjoyed the video. Be sure to subscribe, and I'll see you at the next video.